Hi, would you like to learn how to spot a stock before it crashes? Sell here before it goes all the way down? Or how about here, you learn to spot the stock and sell here before it tumbles all the way down? Or sell the stock here before it goes down? Well, if your answer is yes, then you've come to the right place, because in this lesson we'll be teaching you how to spot stock before there's a sell-off. And if you want to see more videos like this, please click the like and subscribe to my channel. Let's talk about the importance of chart patterns. Before we go into the individual chart patterns, let me explain a bit to you why we need to study chart patterns. First of all, chart patterns are actually the footprints of money, and chart patterns form over a period of time. Some chart patterns can form in 20 days, some about 50 to 100 days. And if you are trading in a weekly chart or hourly chart, it can form within 15 bars, 50 bars or 100 bars. And as these chart patterns form over a period of time, they actually are the collective actions of market participants which experience the emotions of fear and greed, and together they can tell us what are the psychology and mindset of the market participants as they go through the trading days or trading bars. Some patterns show lack of buying power, and some patterns also show certain participants selling. And all this can be very predictive, and you can use these chart patterns to sell the stock early if you're holding the stock, or you can use these chart patterns to short stocks. Okay, let's look at our first chart pattern, the double top. Now the double top looks exactly like an M pattern. It looks like an M alphabet, and if you know about the double bottom, it's actually the opposite of the double bottom. So what happens in the double top? The stock trades up, which is a high, then it declines to form this swing low here. Then it tries to go back up, but it's unable to go above the highs here to form a higher high. It can go, the highs here are about the same. Maybe it can go a bit higher, a bit lower, but it cannot make a higher high and a higher low. So what it does is it stops going higher here and it declines, and it forms to the top here, and that's why we call it a double top. The swing low here, we can call it the neckline. And how do we trade this stock, this chart pattern? We can trade it by shorting the stock when it trades below the neckline here, and we can put a stop loss above here. For those who are more aggressive, you can enter here as it forms a second top here in anticipation that it will go down. Now there are the pros and cons of entering early or entering a bit later. If you enter more, here is a more aggressive, you might get whipsaws, and of course the pros is your reward to risk will be higher. If you enter here, your reward to risk will be lower, but you will get less whipsaws as the stock most likely won't go above here. But if you enter here, you might get whipsaws as the stock might just trade back above and then only decline. So how do you get an target? The initial target, you take the height of from the neckline here to the top here, and then you project it downwards from the neckline to get an initial target. Now do remember that many times the double top, after it has formed, it can go way lower than the initial target, and that is where some support and resistance analysis needs to come in. So let's take a look at some examples. Here we have Archer Daniel Midlands stock trade high up to here, and then it declined a bit to form a swing low here, and then it tries to go up, but it is unable to make a higher high, a higher low, and it stops about this area of the first previous high. Then it declines all the way. Now sometimes the presence of a double top pattern can be very damaging to the stock, and not only does it decline a bit, it can decline all the way down here. Let's look at the stock here. It declined from about 87 all the way down to 70, and if you're holding the stock, it can be very terrible. So how do you actually short the stock? This is the swing low, we call it neckline. The moment it trades below this neckline, you short it and you put a stop loss here above the pattern. And if you've taken this trade, it actually gave you a very big, very good reward to risk ratio, right? If you cover the short here. Now for those who are new, you might not know what shorting stocks mean. When you short the stock, basically you make money when the stock goes down. It's just the opposite of buying stocks. When you buy stocks, you long stocks, you get a profit when the stock goes up. When you short the stock, you get the profit when it drops. So how about an aggressive entry? Now a lot of textbook or courses might not teach you an aggressive entry, but sometimes you can enter early about here, as the stock has already formed a second top here, in anticipation that it will break below the neckline. You can actually enter here, and if you put a stop loss right around here, your reward to risk is very good, especially if you the stock goes down. Sometimes your reward to risk can be 6 to 7 times the risk. The reward is 7 times more than the risk, and that is why you want to have an aggressive entry. The downside of an aggressive entry is you might get whipsaw. Sometimes the stock may gap up and it can cause you a big loss. So do take that into a consideration. Now, how do you enter an aggressive trade? Now, this is the same stock, Archer Daniel Midland daily chart, right? You enter aggressively by using indicators such as the MACD or indicators such as stochastics or RSI, whichever you find useful. So I use the MACD here. Sometimes you can use stochastics, but let's take an example from MACD here. The stock made same highs, first high, second high, to form a double top, but look at what happened to the MACD. The histogram, there's a high here, but there's no histogram above the zero. It just dropped below the zero, and this is actually a sell signal. A sell signal when the MACD lines cross, right? So the MACD was giving a sell signal. The stock was having same highs, but there's a bearish divergence when the MACD histogram high here is lower here. The MACD lines also top here. The second top here was lower, so we have bearish divergence. So sometimes you can just enter here, find candlestick patterns. Here we have a topping tail candlestick pattern. You can maybe just short below the candlestick pattern, put a stop loss here, because there's already a bearish divergence, so the possibility of it going lower, right, is very high. And look how it went down, especially when you have a sell signal. Smooth railroad tracks in the MACD up to here. So if you have entered an aggressive trade, it is a very profitable trade with high reward to risk ratio. Now let's talk about a bit about trade management before we continue to other chart patterns. It's very useful. You can also use it in other types of chart patterns, but let's talk a little bit about trade management. sometimes trade management is much more important than the chart pattern itself. Now, once you enter a trade, you must always place a stop loss. Stop loss is very, very important. It's like buying an insurance, especially when you are shorting stocks. You just don't know how high it can go up. With buying stocks, if you buy or long stocks, your risk is just limited, right? The stock can only fall to zero. But when you short stocks can sometimes go up way more, especially if it gaps up. So always remember to place a stop loss. And when you're shorting stock, always remember the initial target. If a chart pattern gives you an initial target, you must honor the target, sell 1/3 or half, cover. When you short the stock, you cover back the short. You cover 1/3 of your position or half of it. And then you raise your stop loss to break even. In the case of short, you actually lower your stop loss to your break even, your entry price. So if you short at 12 and it's reached your target of 11, you cover 1/3 or half, and then you put your stop loss at your entry price. If the stock falls to a strong support area, you should consider closing all of your position, because strong support areas need a lot of power to overcome it. So do remember, if you have strong support area below, maybe you should close maybe 2/3 or maybe close all of your position. And if you're just learning bearish reversal chart pattern, if you are new, enter only one position at the beginning and brief the trade, live through the trade, Now, as a beginner, you should always observe a particular chart pattern, learn, take notes, and by the time you do 10 trades or 15 trades of the same chart pattern, right, you will have become very good at it. And if you do it more than 30-40 times, then you slowly become a master of the chart pattern. So take it slow. Don't rush into a chart pattern. Maybe you paper trade it, and then you start small, and then you increase your position size with real money. So everything, you need to start somewhere, but proper trade management, you'll be able to come out winning in the long run. Now let's continue to move on to the next chart pattern. The next chart pattern is called the triple top. The triple top is actually an extension of the double top. Instead of 2 tops, you get a three top. Okay, the stock moves up, cannot go any higher. It declines, make a swing low. Then it tries to move up, but cannot make a new highs. The high is about the same as the first high. Then it declines, make a swing low, which is about the same area as the first low. Then it reverses back up, but it cannot go any higher. It reaches an area around here, and then it declines all the way down. And sometimes when you see the triple top happening, the decline can be very massive. Market tops, stock tops can happen when there's a triple top chart pattern appearing. So the swing lows here, we can connect them and we can call it a neckline. How do you trade the triple top? You short the breakdown when the stock declines below the neckline, and you place a stop loss above the entire chart pattern. How do you get the initial target? You take the highs from the neckline to the top here, and then you project it downwards from the breakdown to get your initial target. But remember, many times the stock can go way lower than the initial target. With regards to volume, sometimes if you see the pattern forming and the volume, you can observe in the chart, if the volume declines as the pattern is forming, let's say the volume is high here, but it kind of declines as the pattern forms, it's another good sign that the triple top chart pattern may be more powerful. But when it comes to stocks dropping, many times you don't need to see heavier volume as it breaks down, or tapering volume as the chart pattern forms, because when the stock falls, it can fall on its own weight, gravity. But when you want to buy a stock, you actually want to see more volume coming in. So when stock drops, gravity will pull it down. Let's take a look at the example of the stock forming a triple top. We have this stock, Bungie Limited, is a daily chart. See how it went from a stage 1 basing and then stage 2 uptrend, right? You can see very powerful move from about 92.5 to about 115. Then it declines, make a swing low here. It tries to go up, but it cannot trade above the highs here. Then it declines, make a low about the same as the first low. Then it goes back up, but can't go any higher. Now the highs of the second high and the third high is a bit lower than the first high, but notice how it's about the same area. So sometimes you don't need to follow exactly the textbook pattern. You need to be smart, you need to be wise, and know there are variations. Sometimes it may not follow exactly textbook, but as long as it's about the same highs, it's good enough for me. So then the stock drops to about this neckline area, and it tries to find support here, but eventually it just broke down. So if you were to short this stock, how would you enter? You would short the breakdown when it trades below the low of the neckline. You put a stop loss here, or if you're less aggressive, the stop loss above the first highs here. So you take the target. How do you get the target? Neckline to the highs of the pattern, you project it downwards to get the initial target. Now remember I mentioned earlier about if there's a strong support below, you might want to close the position early. Instead of waiting for it to drop all the way back to 90. Why? You need to close a bit early here. First of all, there's support here. There's 200 MA, rising 200 MA. If you do not know, the 200 MA, 200-day moving average, can be a very strong area of support. And you drop here from a bottoming tail, right? Bottoming tail is a bullish reversal pattern, and it forms a double bottom here. So we have double top here, double bottom here. Double bottom is exactly the reverse of double top. So stock went back up here, and if you were holding all the time before it drops back here, you'll be wasting a lot of time. So always remember, if there's a strong area of support below, or strong value of support like 200 MA, you just want to, when it reaches, you just close up the whole position. You've already made your profit. You want to move on to the next chart pattern, next trading candidate, instead of holding all the way down to December. From October you hold to December, you'll be wasting 2 months. Let's take another example. This stock, MCore Technology, decline from stage 1 base here, and then start a new uptrend, stage 2 uptrend here. And look at this stock, how it formed one top, decline, second top, decline, third top, decline. Now sometimes the swing low might not go exactly down to the neckline here, but you have this drop to around this neckline here, so you must be a bit smart. Don't follow textbook all the time. If you have more experience in the market, you begin to spot variations of the triple bottom. Don't follow, always look at the textbook. You must learn how to recognize patterns. Here, why is a triple top? Because it's relatively same highs, and the fact that this stock is unable to move any higher, it means that a lot of people there's lack of buying power in the stock. Okay, if it's a great stock, it should be making highs, higher, go higher. It can drop all it wants, but it needs to continue to move higher. If it's strong stock, the fact it cannot go any higher, it means there's selling pressure, there's not enough buying power. So if you look at the volume here, it kind of go back down a bit. You know, there's strong volume here, but you don't see any higher volume as the pattern develops. So there's maybe lack of buying power here, or buying interest. So how do you trade this stock? You short it when it breaks below the lows here, put a stop loss here or here, highs here, and then you just write it down. See, you take the target, the neckline to the highs, you project it downwards, right? Now, this pattern actually gave you some of a nightmare for those who short, because it went back up, but eventually the stock just dropped. This tells us that trading sometimes, you know, you need to follow your plan and you need to be patient, because stocks do not always follow the textbook pattern. Okay, and second thing is, it shows the power of the triple top pattern. Once it manifests itself, show itself, look how the stock went down all the way here. So if you have been holding the stock, you know, you could have just got out here instead of here. So that's the power of chart pattern analysis. Instead of selling late, you can actually sell early. Or if you are smart, you are resourceful, you can actually short the stock instead of you know, just watching it go down. You can actually profit from the sell-off. Now let's move on to our next chart pattern. It's called the rounded top pattern. This rounded top pattern, well, it really just looks like a rounded top. Okay, and the stock trades, but it's not following, you know, the what they call it, the uptrend type. Let me just draw what the uptrend looks like. Uptrend, you should be doing like this, right? So instead of this, the stock actually trade like this, and 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 then goes down. So compare this, right? You compare this to this. Okay, what does this tell you? This tells you the stock, although it corrects, there is strength and is going up. This one, there's lack of strength and it's just eventually go down. So from bullish to bearish, right? From bullish to bearish. Now you would just sometimes it's a consolidation here. You will short the stock below the consolidation, right? And put a stop loss here. You can sometimes short here, or depends on what some of these patterns that form. If it's a consolidation, you short below the consolidation. But the rounded top is much more for you to spot the top. I won't advise you to trade out of this rounded top, because there are many other better patterns to trade on. So it's more for you to spot, you know, that hey, you should not hold the stock any longer. If you see it rounded and not going up, you know, in an uptrend, you should just maybe sell off your stock. Let's take a look at the example of how a rounded top works. So we have Pure Cycle Technologies. This is a daily chart. Stock traded sideways and then start to make higher highs, higher lows, eventually gap up, but unable to move higher, making higher highs or higher lows. Instead, it kind of drifted sideways and eventually from sideways trading. This looks like a rounded top. So we have this consolidation here, and when it broke below this neckline, it fell all the way down to $4.18. So how do we trade it? So for the rounded top, you need a kind of sideways consolidation, and when it breaks below this consolidation, the sideways trading, you short the stock and you put a stop loss at the highs of the entire pattern. To get an initial target, you take the height from the neckline up to the highs here of the pattern, and you project it downwards from the breakdown. This is the initial target but of course the stock continued to move lower from there. You can often draw an uptrend line to connect the lows here, and you can use the uptrend line as a gauge of also when the stock is gonna change trend from uptrend to downtrend. So do remember to draw uptrend lines if there is, because sometimes the moment it drops below a chart pattern, it can also be dropping below an uptrend line, and that makes the bearish reversal even more powerful. Now let's continue with the next bearish reversal chart pattern. This is called the head and shoulders chart pattern, not the shampoo, but it's actually a topping pattern in stocks, in the stock market. Now what happens here is that stock goes up, makes a high here, and then it declines to make a swing low here, and then stock continues to move higher as if it's continuing an uptrend. It makes a swing high here, and then it drops all the way down to the previous low here, form a swing low. Now all this seems still normal, but the stock tries to move up, but it is unable to move higher than the highs here. So it just kind of stops moving up when it reaches the area of the left shoulder. It forms a swing high here and just drops. So this shows that the stock lacks bullish power. It's unable to move above the head, and that's why it's a bearish pattern. So we have the left shoulder and right shoulder, which is about the same height, and the head, which is higher than the left shoulder and right shoulder. And that's why it's a bearish reversal pattern, because there's lack of conviction from the buyers. Now how do you trade this pattern? You short the stock when it breaks below the neckline. You get a neckline by connecting the lows, the two swing lows here. You short the stock, and there are a few ways to put your stop loss. Either you can put it at the height of this right shoulder, or if you are more conservative, you can put the stop loss at the head. To get a target, you take the height from the neckline to the head and project it downwards from the area that you shot to get an initial target. But as always, this is just the first target, and sometimes the stock can drop much more lower than that. Let's take a look at the example. This stock has been trading sideways, basing, then starts a new uptrend, makes higher high, higher lows, and eventually it goes up here, have a sharp drop here, moves higher to form the head, and then drops to form a swing low here, then try to move higher, but unable to go above the head here. Right? So it just stopped going up here, which is about the same height of the first shoulder here, and it drops. So this is the left shoulder, this is the head, and it's the right shoulder. And notice the neckline here is actually slanting up. Compared to the previous image here, the neckline is horizontal. So sometimes you won't be able to find a textbook situation in many charts, but it still works because you need to connect the swing lows here. Sometimes it will be slanting up, sometimes it will be slanting down, but the thing is, when the stock breaks below the trend line, which you can draw by connecting the swing lows here, when it drops below the neckline, you can actually short stop. And I guess many traders saw this pattern, because you see the moment it breaks below the trend line, there was not even a trading, just a gap down, and what you can do is just short the stock the moment it opens trading and ride it lower. See how low it went, around 40. You can place a stop loss here if you are more aggressive, or if you are more conservative, you can place a stop loss here. To get the target, you take the lows of the neckline here, project to the highs here, and then project it downwards from the break of the trend line. See how the stock met the target very quick. And one thing to take note is, as the pattern forms, there was declining volume. This shows there's lack of conviction with the buyers, lack of buying power, and selling pressure came in, and look how it drops. So sometimes it's you need to pay attention to what the chart is telling you, because this might just be a top. If you have just you have paid attention, if you sold here, you have saved yourself from a lot of pain. Or if you are sophisticated trader, you can just short the stock here, place a stop loss there, and look, the reward to this was actually quite good. Let's take a look at another example. This stock was in an uptrend all the way, making higher lows, higher lows, higher lows. Went up here, formed the left shoulder, formed a swing low here, and then moved back up higher than the left shoulder to form the head, and then it declined and formed a swing low here and moved back up, but unable to go above the head here. Now, the moment that the stock cannot go above the previous swing high here, it should give you an indication that it's a lack of buying interest in the stock. So which is why when it broke below this neckline, it just went out all the way like that. Very bearish setup. And this is the neckline where you connect the lows, the swing lows here, and it also coincides with a longer daily trend line break, where you connect the lows here, the lows here, the lows here, the lows here, make one line. And it's not only a break of a neckline, but it's actually the break here is a break of a daily downtrend line, which makes it more bearish. So traders can short the breakdown here. If you're aggressive, put a stop loss here. Less aggressive, put a stop loss here. To get the initial target, take the neckline to the head, the height of it, and project it downwards to get the target. And this stock is actually met its target already. So this is a support area, so you might want to close the position. So notice this is a formation of the pattern, but while it's forming, there was declining volume, which shows lack of buying interest, lack of buying power, and selling pressures came in. Now let's take a look at next chart pattern. This is called the descending triangle. Descending triangle just looks like a triangle, but it's actually making lower highs, but the lows here are the same. So you see the stock trading down, makes a high here, goes down to form a low which is about the same low as the first, and goes higher but unable to go above the previous height here. And it just decline about the same low, go up again, but unable to go above the previous high, declines about the same area, goes up, and finally it breaks down. So you can connect the highs to make a trend line, and you connect the lows to make a trend line, and when you draw these two trend lines, you can actually see a descending triangle. So the trader can short the breakdown. This is a support area, but the stock is unable to hold and it breaks down. So you short the stock here, and depending on how aggressive you are, you can put your stop loss along the trend line. If you are more aggressive, you put it here. If you are less and less aggressive, you put it here. And eventually, if you're a very conservative trader, you can put it all the way up above the entire chart pattern. So how do you get the first target? You take the height of this pattern, project it downwards to get a target. So all these chart patterns are very, very good actually, because they give you a target that makes you very realistic to make you more realistic when it comes to your trading. So sometimes if you see the initial target here and there's a heavy strong support here, you might as well just take all your positions off the table. Let's take an example. So we have this stock going up, uptrend, right? But a very weak uptrend, and then it declines, tries to go higher but unable to go above the high here, declines going up, but eventually it just breaks down. This might not be like the textbook chart pattern, the descending triangle, but the important thing is for you to recognize the variations of it. Same lows, but lower high. So when you draw this trend line here, it actually starts to look like an ascending triangle. And the stop breakdown, so you can short stop here, put a stop loss maybe here, or if you're conservative, put it here. Notice here's a bearish cross as well, where the faster MA cross below the slower MA. The 20 MA cross below the 50 MA to get a bearish cross. The moment it breaks down, see it very bearish. This is a declining 20 MA, declining 50 MA. So this stock was actually in a very bearish position. Target has been met. Okay, you take the heights, project it downwards. The target has already been met. And what is interesting is sometimes that you can see the same chart pattern appearing in the same stock in a short period of time. This is a bearish reversal descending triangle, but this is a bearish continuation pattern. So the descending triangle is very versatile actually. It's very flexible. You can use it as a bearish reversal pattern, as also as a bearish continuation pattern. Trader can short here, put a stop loss here, and maybe it has kind of met the target. But we are dealing with a bearish reversal pattern, so we're not going to deal with it as a bearish continuation. So as the pattern form, look, there's a declining volume as well that shows a lack of conviction on the buyer's side. So when there is declining volume, as the stock forms the pattern, there's also selling pressure coming in, which is why the stock quickly dropped and met the target. Let's move on to our next chart pattern. It's a bearish wedge. Actually, it's you can call it the rising wedge pattern as well. Although the stock is rising, actually it was very it's kind of bearish situation, because if this stock was in a strong uptrend, it will be something like this. Stock will be making something like this. Okay. So, but if you look at the stock is actually making highs here, lows, high, low, high, but it's kind of contracting, but it's not really moving much higher. Okay? And if you connect the lows and the highs, the lower trend line is actually steeper than the upper trend line, because there's a lack of bullish movement like this. This slowing down of the momentum, bullish momentum, is actually showing a bearish signal, because strong stock should be going up in a healthy way, not gradually moving higher and contracting. This show lack of buying conviction. So eventually, if the stock breaks below the lower trend line, right, it's going to be bearish, and traders can actually short the breakdown here, put a stop loss about here. Target, you can take the entire height of the pattern, project it downwards to get an initial target. So let's take a look at this example. Cushman and Wakefield daily chart. Stock trying to move higher, but you can see the stock forms a bearish wedge. The moment it trades below trend line, you can actually short it, and the stock went lower. So stop loss can be put around here. And why is it bearish? Because also because of the declining 200-day moving average. So stocks that try to move up but is below the 200 MA forms a bearish wedge. Actually can become a bearish reverse pattern, and stock moves lower. Here we have another situation where stock was above the 50 MA and 200 MA. Stock tries to move up, eventually forms a bearish wedge, connect the highs and the lows. You can see the lower trend line is steeper than the upper trend line, and a lot of people are watching this bearish wedge. How we know? Because there's a strong sell off here. the moment it breaks below the lower trend line. So you can short it here. You take the height of this pattern, project it downwards to get this target. So the target has been met. But notice how powerful this bearish wedge is. When it forms, it's actually from the top of this stock for this midterm. It top out around end of July and just decline all the way to October. Notice also, as the stock was going up and forming the pattern, there was declining volume, which shows lack of conviction from the buyers. And if you look carefully, it's actually a kind of head and shoulders pattern as well. So it's good for you to learn many different patterns, because the more you learn, the more you can see the different chart patterns. And if you have two chart patterns forming within a same stock, it can actually be more powerful. So this straw for you to see this head and shoulders pattern. Right, if you take the height of this pattern and you project it downwards, it's more than met. Perhaps the target is around here. Okay, it's more than met the target. So you have a bearish wedge that give you a first warning, and the larger head and shoulders pattern to give you the bigger target. And now let's move on to the next bearish chart pattern, which is a bearish gap. Actually, it's just a gap down from a high price to a very low price. There's no trading in between. Let's say the stock is trading up to 200, and suddenly the next day, because of bad news or earnings, it just gap down without any trading between 200 and 180. So that's like a 10% drop overnight, which can be very scary for many people, and which is why many times when you see the stock gap down by 20, it can actually end up losing more than 10%, maybe 20%. So what is important is stop moving up, but sudden gap down the next day. So I'm just showing you this pattern here for you to recognize it, especially when the stock is making an uptrend. Let's say the stock is going up like this, and suddenly the next day it opens up here. Guess what will happen? Let's say this is 100 and it opens at 80 the next day. It's a 20% drop. So there's going to be a lot of panic selling, and probably stock will go down, and it begins at the start of a new down trend. Okay, that is what can happen. So let's take a look at the example. We have this stock moving higher, even gap up, kind of form rounding top. Can you see the kind of rounding top here? So not a very good sign. The next day the stock gaps down here. Okay, so imagine the shock that people hold this stock here, gap down, and as it trade down, there was heavy volume, showing a lot of people were selling. As this rounding top pattern was forming, the volume also declined, showing lack of buying power, buying interest. And the gap down actually started a like kind of new downtrend. Look how the stock actually dropped from 90 over bucks to 62.50. So whenever you see the stock uptrend, suddenly there's a gap down, you need to be very careful. So things to note, shorting stocks can actually be very risky. That's why earlier I mentioned about trade management, because stocks can just reverse back up and go up 100, 200, 300%. If there's no stop loss, right, you tend to be in a very risky position. Always watch for support areas. If you have stock that's dropping to a strong support area, you should take your profits faster. Because why wait? Because it's going to take a lot of strength to overcome a strong support area. So when you short stocks, you should take your profits faster compared to buying stocks, because stocks generally fall faster. Your profits will come faster, but also because of the risks I mentioned earlier. So you might want to use a trend following method. Here's a bonus for you, which I'm going to show you. You can actually use a trend following method to know when the stock is about to go back up. Alright, let me just show you this chart of this ACGL. Alright, let me just show you this chart of ACGL. We've looked at it just now. Here I've overlaid the 20 period moving average, which is red line, and the 50 MA. So what I like to do is use these two moving average as a gauge of the trend strength. So when a stock is above the 20 MA, it's very bullish in the short term. If the stock is above the 50 MA, then it's bullish in the mid term. So when you look at this chart, what you can learn from this is when the stock is above the 20 MA short term, it's bullish. When it's below the 20 MA short term, not so good. And when the stock is below the 50 MA, it's a sign that the stock is not very healthy. So we have this head and shoulders pattern here. Draw an uptrend line, and when the stock drops below the uptrend line and the neckline, it also dropped below the 20 MA and 50 MA, which makes it more bearish. So this trend following tool using the 20 MA and 50 MA is actually quite useful. Let's take a look at AEHR. AEHR, we have this double top formation here, double top, and we can draw a trend line, connects the here. Okay, so double top and near the uptrend line, and look where the stock is relative to the 20 MA and 50 MA. When it was above the 20 MA, things are good. When it starts to go below the 20 MA and 50 MA, right, see how it dropped below the double top snack line here, and here's a bearish cross, and it's below the 20 MA, below the declining 50 MA. That's why the stock is moving down. And let's take a look at AZZEK. Here we have a stock making a double top here, and you can actually draw a trend line connecting this lows here. So double top, and when it broke below the middle here, middle swing here, it was actually below the 20 MA and 50 MA. Before that, it was above it. So when you have a stock chart pattern, that bearish chart pattern, by the moment the stock breaks below the neckline and below the 50 MA and 20 MA, it can actually be very bearish. And look, you can continue to be bearish short term as long as the stock stays below 20 MA. So I hope this short lesson on the bearish reversal chart pattern has really helped you. And if it's helpful and you learn something, do like my video and subscribe to my channel, and see you in the next one.